Hello, my name is Mike Levie, and I'm currently a student at Southern Utah University, and I'm pursuing a Master's of Accountancy. And today I would like to present to you an ethical dilemma scenario that is found in the text titled Understanding Accounting Ethics, 2nd edition, written by Sheffers and Pakaluk. This scenario can be found in Chapter 5. It's Scenario 5, and it's titled Who Authorizes Your Paycheck? This scenario can be found on page 160 of the text. So to get started, let's talk about the facts of the case. We have an internal auditor. His name is William McGee. He's the internal auditor for a business called Premier Printers. Premier Printers is in the business of printing and distributing books. They distribute books and also take books back in return. To account for these transactions, they have to create and credit accounts receivable, and they're continually doing this as they make more and more transactions. They do, however, have times when they have a flawed production run, and so if they have a flawed production run and they send it out to customers, sometimes the customer will only pay for the part of the order that they feel is not flawed, which results in a short paid invoice. Now this makes it very difficult to keep track of the running balances of these customers, and therefore William McGee is, as the internal auditor, he does a review of the accounts receivable to make sure that the balances are correct. As he does his review, he finds that in many instances there are customers with large orders that have deemed their part of their order flawed, and so they will in fact short pay these invoices. But what he finds out is that the accounts receivable clerks are not crediting the original invoice for that short payment, but what they're doing is they're applying the short payment to previous carried over balances from other invoices that had been short paid, and this therefore covers up those short payments and just perpetuates the problem of having receivables that really aren't collectible. He further finds out that the CFO is the one that has instructed the AR clerks to apply all these payments to carried over balances. The CFO's motivation for this, there's a few things that motivate him to do this. One is he says accounts receivable is understaffed, and McGee finds out that yeah, this is the case, they're understaffed and they haven't really had time to go and clean up these accounts, and so that's one of the reasons that he just tells them just apply these payments against outstanding balances on the earliest invoices. The CFO is also very dismissive of the customer's claims. He regards all invoices as collectible because he says that a lot of the claims lack basis from the customers. However, he's not pursuing these claims with the customers, so he's not resolving them. And the last bit of motivation that's the most suspect is that this policy that he has of just applying it against old invoices and therefore wiping out possible write-offs, as it leads to stronger profits for the company, and he receives bonuses for strong profits, so he has a motivation to boost his numbers and make sure they have strong profits. So McGee confronts the CFO about his policy. He tells him, hey, your policy's misguided, it needs to be changed. He says, you can't do that. The CFO responds to him and says, tell me, McGee. He says, oh, I can't do that? Tell me, McGee, who authorizes your paycheck? So we have a dilemma here. McGee knows that the accounts receivable are overstated, that they haven't been applied correctly, but he also knows that he knows that the CFO is his boss and could potentially make his job miserable for one, and he could also potentially fire him for going against what he asks. So that's his ethical dilemma here. So the question is, what should McGee do? The text recommends or suggests 4 solutions and asks us to look at them and decide which one we think is best. First one that that it suggests is that he could just do what the CFO asks. This one, in the text it says the distinctive task of an accountant as a professional is to seek and declare the truth about the financial condition of the company in order to provide for conditions of trust in a modern market economy. So we can see from this one, it's two-part, this distinctive task. It says it's to seek out and declare. So McGee has done the first part. He went and he sought the truth. He found it. Now he needs to declare it. So we know this isn't going to be the solution. He can't just keep doing what the CFO asks to do. It's not right. So the next one it suggests is to go directly to the president of the company and boldly tell him that the accounts receivable balance has gotten out of control, and that there's going to be huge unexpected losses when this all comes to a head, and it could be catastrophic for the company and could affect the livelihood of both the president and McGee himself. So as we look at this solution and evaluate it, this does illustrate the structural problem that accounting faces, right? The president is still indirectly McGee's boss, so he's paying him, and McGee is actually representing the board of directors and the owners of the company. So going to the president might not be the best idea, and also in this solution it suggests that he tell the president that, hey, our livelihoods are at stake here. So that that's a personal interest of McGee's. He should probably leave that out of the solution if we're talking about ethics here and using good ethical judgment. The next one it suggests is that we go to the external auditor, or that McGee go to the external auditor and tip them off to what's going on in accounts receivable in a way that they'll look at it, but the CFO won't know when he's being audited by the external auditor that McGee was the one that tipped him off. So this solution to me seems okay. He's gonna get the ball rolling and get this out in the open, but it seems to me he lacks some moral courage. Moral courage is doing the right thing no matter the consequences. And this one to me feels like he's trying to dodge the consequences of having to face up and confront the CFO and the board of directors. So although a decent solution, I don't think it's the best one. The very last one they suggest is to speak with the owners and the board of directors of the company and talk to them about what's going on. Let them know about the misrepresentations of accounts receivable. And I think this is probably the best solution. I mean, he is really supposed to represent their interests and should declare this truth that he's discovered to them. So the solution, as we talked about, I think the last one is probably the best one. To go to the board of directors, but I also think that maybe if we mix this one with the one of going to the president, but go to the president in a little different light, maybe not talk about, hey, this is going to affect our livelihoods, we got to do something to protect ourselves, but more to go to him and say, hey, this is what I found out about the CFO, get his thoughts before you run straight to the board, and then let him know that, hey, I think we need to talk to the board, and I'm going to talk to the board of directors so that we can get this resolved. So I think that would probably be the best solution.